looked at EOQ with discount. The economic batch quantity that is indicated in the handout is not there in the syllabus, but you can just read it if you so wish, but it's not there. Then now there is what we call, what is remaining this topic is what we call the qualitative model of stock control. So we have qualitative model of stock control, qualitative model of stock control, qualitative models of stock control. So we have what we call the qualitative models of stock control. And here we are talking about two models. Number one is what we call just-in-time system. Just-in-time system. So this is oftenly examined, this just-in-time system. So the qualitative models ensures efficient utilization of stock materials. So we have number one is just-in-time system, and number two is what we call the ABC system. ABC system. So I want to imagine all those students online, they have notes. In case you don't have notes and haven't sent you, kindly remind me again, I'll send you today. So we have just-in-time system. I have seen so many questions on just-in-time system. So it's a very, very common testing area, just-in-time system, okay? So what does it mean? So this one aims at eliminating holding stocks. So it's a system whereby items are only manufactured and supplied when needed. So the aim of manufacturing, it was developed by Toyota company in Japan. So the aim is to manufacture the required high quality at the time when they are required. So when it comes to just-in-time system, you only manufacture when an item is required, meaning you don't keep inventory at your place. So you only order what is required. So it is now, for example, motor vehicle industry. You only order spare parts or whatever is needed when there's an order for the same. So you don't keep stock. That is what is called just-in-time system. So it eliminates stock holding. It eliminates stock holding. So you need to know the advantages and features of this system. It emphasizes on the perfect quality. So it emphasizes on the perfect quality, number one. And then it eliminates non-value added activities of the product. And there's 100% on delivery, on time delivery. And then number four, it is a demand pool manufacturing system, i.e. items are manufactured at the request of the customer. So you only manufacture an item when it is requested. And then it normally involves a short setup time. The assembly period is very short. And lastly, there's no opening and closing inventory. So it doesn't encourage keeping of inventory. So you need to know the features. You need to know what it means by just-in-time system. So he's saying this is a system where items are only manufactured or assembled when they are required. So you don't keep any item around. You only manufacture it when it's already needed. So there's no need to keep stock around. Disadvantages, it is not applicable for items that are perishable. So in other words, it cannot be applicable where items are perishable. And number two, it is affected by outdated technology. It heavily relies on technology. And therefore, when we have obsolete technology, it affects its operation. Number three, it is affected by the machine breakdown. It relies heavily on the machines. And therefore, if there is any breakdown on the machine, then it will bring a lot of issues and problems. So that is what we call the just-in-time system. So there are several questions on just-in-time system. As we progress, we'll be able to identify those questions and attempt them. So let us look at the next system on the qualitative model of stock control. We call it ABC analysis or Pareto analysis. So ABC analysis or Pareto analysis. So it's a system which groups items into three groups depending on their values as follows. So under this system, items are categorized into three systems according to their value. So we have item A. So these items are few in number, but they are of high value in business compared to item B and C. So item A are those items that are high valued. In other words, in case the business loses them, then there's a high loss, this item A. So there's a lot of security that's offered on these items. Like, for example, you are dealing with this airtime or airtime. You're dealing with airtime. Then you have those ones that you can be able to sell at 1,000. Those ones you can be able to sell at 500, maybe 100. So this one you can categorize them as A items. This one as B item and C. So here you give more security and attention. Here you incur more cost in terms of security and attention, because if you lose one card, you lose 1,000. If you lose 10 cards, you lose 10,000. And like here, when you lose 10 cards, you only lose 1,000. So the values, so items are categorized according to their values, and the security measures given, they are given depending on how valuable an item is. And then we have item B items. They are more than A items in number, but of low value. B items are more in number, but compared to A, their value is less, it's a little bit less. The control measures put in place here are not as strict as those ones as A. We have control measures here, but not as strict as A. So like we have given here, these values here, you are selling airtime of 1,500 and 100. This one, you make sure nobody knows where they are kept, isn't it? Only maybe one person. That person who goes into that, you keep them very, very secure. And then B items, yes, we have control measures in terms of security, but not strict as A items. And finally, we have C items. Those are many numbers and of low value than A. The control measures are not as strict as those one of A item. So that is what we call Pareto analysis. And now lastly, the last aspect of inventory control is what is called, the last aspect of inventory control is what it's called inventory control itself. What we call inventory control. Inventory control, these are systems used to carry out stock taking activities. So we have systems that are used to take out stock taking activities. We call them inventory controls. And we have two systems of determining the inventory value at the end of the period and determining the number of units that we have, the quantity of stock and the value at the end of at the end of particular period or at the end of every day. So we have two systems of doing that. We call it periodic. We have what we call periodic inventory system. Periodic inventory system or physical. Number two, we have what we call continuous stroke perpetual system. So we have those two systems. When we talk about physical, here is where the activities of an enterprise are stopped for a while, and then the stock items are physically counted. And then you attach value to those items counted. Like, for example, in this classroom, we are assuming this is our stock item. So at the end of the month, we stop our normal trading activities, and then we physically count the items that are there. We count 1, 2, 3, 4, 5. And then we say we have maybe 1,000 units. And then we attach each unit, maybe we attach the value, it is 100. So that one will be able to determine the stock value at the end of the period. That is called the periodic inventory system. This is where stock taking done at the end of the accounting period. It involves the verification of the stock items at the end of the period to estimate the closing balance of the inventory. That is what we call the physical or the periodic inventory system, this one. Then we have what we call the continuous stroke perpetual inventory system. So here, the stock item is updated every time there is issue or receipt. Every time you receive a nice stock item, you update. Every time you issue, you update. So you are able to know the stock quantity at every time and values. And we have several methods that we use to facilitate this process, like FIFO, LIFO. So you update stock items every time there is receipts and there is issue. That is what we call the perpetual. So we want to look at those perpetual system using those methods. So it's a system of recording the stock balance after receipts and issue in order to facilitate regular checking, to establish the closing stock of the items using methods like FIFO, LIFO, and weighted average. So now we want to learn how to determine the stock values perpetually using those methods. The first method that we want to look at is what we call FIFO method. FIFO. So we want to look at the first method. Is called, we are looking at the stock control. The aim of stock control is to determine the quantity in store at any given date and the value in store. That is the purpose. And we are saying we have two systems. We have the perpetual and we have the continuous. So the perpetual, I hope everybody have understood it. Now we want to, sorry, the periodic. Now we want to look at the perpetual. So the perpetuals are facilitated by methods such as FIFO, LIFO, weighted average, and simple average. So we want to look at those methods, and that one will bring us to the end of that particular topic. So the first method is called FIFO. FIFO means fast in, fast out. FIFO, fast in, fast out. So the stock item that came in fast is the one that is issued out fast. That is what it means by FIFO. The stock item that came in fast is the one that is issued out fast. So we want to look at an example, November 2015, question number 3B. CPA November 2015, question number 3B. We are looking at FIFO method of stock valuation. FIFO. November 2015, question number 3B. I hope you have those past papers. We shared them in the group, isn't it? What group? What group? Mforwardie huyo past paper. Uko na past paper? Empatie namba yako akuforwardie. Nani mwingine hana? So it is good even you can organize and have copies. It is easier to deal with them when they are copied, isn't it? So in case you don't have copies, we have them from you. I told you it's very cheap. It's only 70 shillings. You have them? Eh? You can be able to get that question. November 2015, question number 3B. November 2015, question number 3B. November 2015, question number 3B. So there's a question, November 2015, question number 3B. November 2015, question number 3B. So the question reads, Kena stores provided the following information in respect of their operation for the month of July 2015. So we have there a table that is indicating the receipts and their respective dates and issues and their respective dates. And then we have additional information. Number one, material in store as at 30th June 2015 were 2,000 units at 50 shillings. And number two, on 9th July 2015, part of the materials issued on 5th July 2015 amounting to 200 units were returned. Number three, on 15th July 2015, 100 units were returned to Kena stores. And number four, on 21st July 2015, there was material wastage of 500 units. And number five, returns from a June 2015 issue of 100 units at 45 were received on 25th July 2015. On number six, on 28th July 2015, there was a shortage of stock of 20 units. And lastly, Kena stores uses the fast in, fast out method, in bracket FIFO, method to value its inventory. So required a store ledger card for Kena stores for the month of July 2015, total marks 14 marks. So those are a lot of marks. So we have a store ledger card. This is where we update our stock items. All the stock items that we open the respective store ledger card to keep on recording the issues and receipts and giving us. So this is how it appears. This is how it appears. The store ledger card. So November 2015. So this is how it appears. So you write the name Kena Store Limited, Kena Stores Limited. So store ledger card, store ledger card for the month of July 2015. July 2015. So this is date. So you can write here July 2015. So that is how the store ledger card appears. And you can see the marks allocated to the entries in that ledger. There are very many marks, 14 marks in total. So now I want to record here. When you're recording, you record them according to dates. So a transaction that occurred earlier should be recorded at earlier than you record it according to dates. Are we together? So now when you go to additional information number 1, material in stores. Material in stores at 30th June 2015 was 2,000 units at 50. So the closing stock in June will be the opening stock in July, isn't it? So we had 2,000 units, isn't it? So you write here fast here. So here you record under the balance here. So here we have quantity, then price, and then here we have amount. Quantity, price, and here we have the amount. Here we have the quantity, and here we have the amount. So on 1st July, they had 2,000 quantities, 2,000 units, in other words. Each unit valued at 50. So you multiply by 50. 2,000 multiplied by 50 is how much? 2,000 multiplied by 50? 11,000. So here you record 100,000. So in other words, they began the month with 2,000 units valued at 100,000. Okay? Now you begin to record according to dates. You check which date occurred first. According to the details we have, on 3rd July, they received 600 units at 60. So you come here and record 3rd July. So you record under 3rd July, they received how many units? 600. So you record here 600. The receiving price was 60 per unit. So here they received 600 units at 60. The total value will be how much? 36,000, is it so? So you record under the value. So you record under the receipts column, the total units received, you multiply by the unit price per unit, and then you get the values. Now these units, you add to the units that are in stock. So here you'll get 2,600 here. Are you getting? And then the value, you add to the value that was in store. So here we have 136,000. That is how we record. So you're able to tell on third, we have, if you ask you're the storeman, you can be able to tell that I have 2,600 units valued at how much? 136. You can give the stock quantities and values at any given time. Then on third, after third, the next transaction is on fifth. On fifth, is it fifth? On fifth is the next one after third. So on fifth here, they issued how many units? 1,600. Remember, we're dealing with what we call, the system they're using is what we call FIFO. The units that were there first are the first one to be issued. So this batch that is being issued out will come from this one that was there. First in, first. So the 1,600 will come from this batch here. So remember, if you are a storekeeper, when you're issuing out stock, you issue with the price that it came in. The receiving price is the issuing price the same. So stock are maintained at cost. So now you issued 1,600, these are coming from this batch. You can have a pencil and note. Now the remaining stock here will be how much? 400. You can note somewhere there, isn't it? So you're issuing from the batch, the opening batch, you're issuing 1,600. So you're remaining with 400. And their price was 50 shillings per unit. So you multiply by 50. So 1,600 times 50 is how much? So you note here 80,000 under amount here. And then now you subtract 2,600 minus 1,600 is how much? Is it 1,000? So you're retaining 1,000. And then now 80,000, 136 minus 80, what is the value? 56,000. So you remain here with 56,000. So that one you've noted, the one that occurred on 5th July. And then the next one is on 7th July. So you come here and write your 7th July. So the 7th July, they received how many units? 1,000 units at 70. Then here it will be how much? 70,000. So you come and add this 1,000 to this one. So you'll have how much? 2,000. So now you add the quantity that came in to the one that was there, so that you have now 2,000. And then the value add to the value that was in. Are we happy? So this one gives you 126,000. That is on 7th. The next transaction or the next activity was done on 9th in note number 2. Even the additional information, you check the dates. So on 9th July 2015, part of material issued on 5th July 2015, amount of 200 were returned. So when you return stocks, you treat them as receipts. When you return stock, you treat them as receipts. So you write here 9. So we had returns 200. So they had been returned, they had been issued on 5th. The issuing price was 50. So you return them with that price. If they've not given you if they tell you returns and they have not specified when were those returns issued, you assume that they came from the latest issue. So yeah, you have been given the returns and they have not specified the date when those returns had been issued, you assume they are coming from the latest issue. So now this one are being returned 200. I'm saying return, you treat them as new receipts. So you multiply. What do you get? So here you get 10,000 here. You add here 10,000. And then now you take two, here you have 2,200. And here 136,000. So that is 9th. After 9th, the next one is on 12th, isn't it? So the next activity is on 12th. So what happened? They issued how many units? 400. First in, first out. First in, first out. So remember, this stock that was in, we have already issued 1,600. We're still remaining with how many? 400. So the batch that is being issued now will come from that remaining batch. So now we're going to issue 400. You write under quantity, under issuing column, 400, and the price is still 50. This one, their price was 50 per unit, isn't it? So we're going to issue them at 50 shillings per unit. So 400 times 50, what do you get? So here 20,000 here. You write here 20,000. So this one now is exhausted. So 500, 400, 2,200 minus 400. 2,200 minus 400. 1,800. 1,800 flat, eh? And then 136,000 minus 20. 116. So here we have 116,000. That is on 12th. After 12th, what is the next transaction? 18th, isn't it? 15th. What happened on 15th? 100,000 were returned to Kenya stores. So 15th here, we have 100 units were returned. They have not specified when those units had been issued, isn't it? Is it so? So now we assume they are coming from this batch here, the latest issue. So here we multiply by 50. So that one will be how much? 5,000. Is it so? The value would be 5,000. Tuko pamoja? Yes. That is a return inward. If you issue and that is you see return. We have the stores, isn't it? So the stores can either issue to the customers or to another department. It can be even production department, isn't it? You understand now? Yeah. So now this 5,000 you deduct from, so 100, this is 1,700. Then you take this value, you deduct from 116. 111. So hii inakuja 111,000. Is it so? 111,000, sindio? Are you sure 111? 116, your 5,000. We are adding, sorry. We are adding, not subtracting. We are adding. So this one is going to be 1,900. Is it so? They are returns. Then now this one is going to be is it 121? We are adding, not subtracting. Unafuata ndugu yangu? Sawa. So unaona ni marks mingi sana wanatouch hapa. Na hii swali imerudiwa sana of late. Hii. Okay, we continue. Which is the next transaction? Is it 18th or 18th, isn't it? So 18th, what happened? The 18th, they receive how many units? 2,000? 2,400. At how much? At 80. When you multiply, what do you get? 192,000. So 192. So you add this one. Eh? 10? 313, eh? 313,000. And then here, 4,300. So this is 4,300. That is on 18th. After 18th, what happened again? The next on 20th, isn't it? So we have 20th. 20th, they issued how many units? 1,200, isn't it? So 1,200 first in, first out. So it will come from this batch. This one is already exhausted. Now they're coming from this. So this one is only 600. So this one we tick 600 at 60. So this is 36,000. And then another 600 will come from the next, isn't it? So now here we remain with how much? 400. First in, first out. So this one will be another, the 600 will come from this batch of that was received at 70. So this one will be 70. So 600 times 70. So this one will give you 1,200, the total. And this other one, 600 times 70. 42,000. 42,000 plus 36,000. 70. So here we have 78,000. And then we subtract 4,300 minus 1,200. Eh? 235,000. So here we have 235,000. And then here 3,000. So here we have 3,100 on 20th. So that is on 20th. On 28. And then we go on, the next one is 25, isn't it? On 21st July 2015, there was a material wastage of 500. So wastage, you treat it as issue. Wastage, you treat it as issue, you eliminate it from the stores. So that is, which date? 21st. So right here, 21st. 21st. There was a wastage of how much? 500 units. So right here, so they are coming from which batch? So here we are still remaining with how many? 400, isn't it? So we're going to write 400, you multiply by 70. This one is now exhausted. Then the remaining 100 is going to come from 50. Is it so? So here we are remaining with how much? 100. So 400 times 70, this now will give us 500. 400 times 70, 88,000. 28,000. And the other one? So this is 5,000. Total? So this one will give you 33,000. And then we subtract 3,100 minus 500. Go to 202,000. $2,600. So that is us at the 21st. After the 21st, what has happened again? 25th. What happened on 25th? Returns from June 2015 of 100. So we had returns. So we had 25th here. We had return that had been issued in the previous month, the month of June. And the price that was used then was 45. So we're going to receive them with 45. So this one is going to be, is it 4,500 or 45? That is going to be 4,500. So we're going to add here. This is going to be 2,700. Is it so? And then the other one amount, 4,500 plus 202. So this one is going to give you 206,500. And then lastly, we have, it's not lastly, 29th, isn't it? Do you have 28th? 28th. There was shortage of tufi. So 28th. So shortage you also treated as issue. We had a shortage of how much? Is it 20 units? 20 units, isn't it? So this 20 units here. So you're going to write here 20. So they're going to come from this batch, isn't it? So here we're going to remain how much? 80. So here you issue 50. 20 times 50. 1,000. So 2,700 minus 20. Huh? 2680. So this one is going to be 2680. And when you subtract 205, 500, isn't it? So that's going to be. And then now the next one is 29th. So 29th, they issued how many units? 600. First in, first out. So this 80 first of all will be exhausted here. So we're going to issue 80 at how much? At 50, isn't it? 80 at 50. And then we also have 100 at 50. So when you take 600 minus 180, how many are remaining? For 20, they're going to come from this 80. So you multiply 80. So we have 80 times 50, that is So now this one will give you a total of 600 here. 80 times 50. Huh? So this one is going to be 4,000. 100. Huh? 3. This is 5,000. And the other one? Eh? 33,600. Then you add. Eh? 42,600. So this one you deduct. What do you get? 62? 162,900. And the other one? Our amount, 162,900. This other one? Eh? 20,80. And lastly, 31st July, they issued how many units? 200 units. So you come here right 31st. They issued 200. So they're going to come from this batch, isn't it? Remember here, so what was the balance here? 2,400 minus 420. And then now the 200 is going to come from that batch at 80. So I'm happy 2080 minus 200. 16. So the value is 16,000, isn't it? So when you subtract 146. So this one is going to give you 146 amount, 146,900. 146,900. And then this one will give you how much? Huh? 1880. Even if you taste, this one was for 2,400 here. 2,400 minus 420 minus 200. What do you remain with? Eh? 1780. 1980. Upper 1980. And then you minus this 100 was also, you add 100 here. This is 1980. Are you sure? 1780, isn't it? 1780 plus now, this one is still remaining, isn't it? So you get 1880. So that one confirms that this is a store in, this is a unit in store, isn't it? So this 1780, if you multiply by 80, you get this value, and this 100 you multiply by 45. It should give you the same value. So now, if you're a storeman, you are able to tell at the end of the month that I'm still retaining 1880 units valued at 146,900. So that is how we record FIFO method. You can take a photo of that, or you can, I think the photo is easier. Alternatively, I have even written it for you, so you don't need to struggle. And then another thing you need to know under FIFO method is the advantages and disadvantages. So you need to, in addition to posting, you also need to know the advantages and disadvantages, which are well outlined in this handout. So that is the first method under FIFO. So it's a very common method. If you check, I think there was also a question of late that came under that method. There's a question, there are two questions that I've seen of late. If you check November 2020, question number 1. So we had a question that asked them to do FIFO method. That one you'll do it. November 2020, question number 1. It had 12 marks attached to it. November 2020. So you try November 2020, question number 1. And then you let me see it. November 2020, question number 1. Tunaelewana? So now we want to look at another method. We call it LIFO. LIFO method. So LIFO is the stock that came in last is the one that is issued out first. It follows us. The one that came in last, the one that is issued out first. So there's a question that was done in June 2008, question number 1B. I don't know whether you have it. June, can you check in your past papers there? Those past papers are in 2. We have those ones that, the old ones. I don't know whether you have two sets of copies. Kuna zile mzee na kuna moja tu. Angalia mzuri. Nazo za June 2008 hapo. Emeo wametuma past paper moja tu. Buni angalie kama naweza watumia hizo zingine. So I think we have the past papers there. They are shared. Although those one are a little bit old, we scanned them. So June 2008. wacha kutumia mfuadie huyu page 55, sindio? So it is there in the page 55. It is shared, the notes, the past papers. So everybody should be having it. So we have 208. It is June 208. June 208, question number. June 208, question number 1B. So the question reads, Ball Nut Limited operates 7 days a week and deals in sales of bolts and nuts. So the company undertook the following transaction during the month of March 2008, purchases for the month of March 2008. So you've been given the purchases, the quantities and their prices. And then we have the sales for the month of March 2008. You'll be given the quantities and their prices. And then we have additional information. Number one, the closing stock for the month of February 2008 was 2,500 units valued at 90,000 shillings. And number two, the following returns were made by the customers on 14th March, 75 units which had been sold on 3rd March. And then on 7th March, 175 units which had been sold on 24th March. Number three, on 22nd March 2008, the officer in charge of stock detected a shortage of 50 units. And then number four, operating expenses for the month of March 2008 amounted to 4,500 shillings. And number five, the company uses last in, first out LIFO method to value its stock. Required, the store ledger card for the month of March 2008, 7 marks. And number two, trading profit and loss account for the month of ended 31st March 2008, 3 marks, total marks, 10 marks. So now that is also, we can do that one. It was done. So we can do that one. So we are using LIFO. LIFO means last in, first out. So the quantity that was issued in first is the one to be issued out first. The quantity that was issued in or to received last is the first to be issued. So now this is June, is it June, February? So the date here is, so yeah, this is March 2008, March 2008. So you have there March 2008. So the closing stock in February will be the opening stock in March 2008, which is in note number 1. So they had 2,500 units at the beginning of the month of March, valued at 90,000. So that is the opening stock. So you indicate there. So that is 1st March. So you write there 1st March. And then here we have purchases and sales. So they are selling. So number, you record according to dates. So the first date, the first transaction occurred on 3rd. So right 3rd here. 3rd, they issued how many units? 350 units. So they will come, this is the last in. There's no any other quantity that was came in except this open balance. So you divide the value against the units in order to know the price per unit. 90,000 you divide by 2,500 so that you can be able to know the price per unit. So how much is it? So now this one we're going to issue with 36. 350 times 36. 36. 12,600. So this is 12,600. And then you subtract 2,500 minus 350. What do you get? Amount 77? 77,400. And then this one 25, 2150. So that one will be the closing stock at that date. Another transaction after third was on fourth. On fourth again, they issued how many units? 500. This one will still come from the opening balance because there's no any other receipts except the opening balance. So they were going to issue it using 36 again. So 500 times 36. Eh? 19,000. 18,000. So 18,000. Again, they were going to deduct it from here. $59,400. Then this one? Oh, 59, sorry. 59,400. And this one? 1640. 1650. So that will be the closing balance as at that date. And then now after fourth, what was the next date? What was the next transaction? On 13th, isn't it? So 13th is the next date. So 13th, they received how many units? They received 1,000 units. At what price? At 38. So the total value will be 38,000. So you add this. So this one will be 2650. Is it so? And then now 38 plus 59,400. What do you get? 97,400. After 13th, the next date was on 14th, isn't it? There was 75 which had been sold on 3rd March. So here we had 14th. We have returns of 75 units which had been sold on 3rd March. So they had been sold by 36. So they returned with 36. 75 times 36. So this one will be 2,700. And then you add 75 plus 2650. Tuko sawa? Inakuja ngapi? $26.50 plus 75. 27.25. 27.25. And then amount. $10. 100, 100. 100, 1. 1001 100, isn't it? So we are done with 14th. The next transaction after 14th, we have 16th, isn't it? We have on 16th. Is it so? 16th, they issued how many units? They issued 400 units. Is it so? So we said last in, first out. So the last in will be this one, isn't it? So we're going to issue this 70. Remember, we still have some stock in the opening balance, but we are not going to consider that one. Last in 75, you multiply by 36. And then now the remaining when you take 400 minus 75, how much? How many are remaining? 325. 325 is going to come from this one times 38. 325. 1000 minus 325. 675 will still be remaining here. 675. So last in, first out. So now 75 times 36. 27. So this one is going to be 2700. And then for 325 times 38. So 12,350. Tumeelewana? So 12,350, you add this one. This one will give you 400. And this other one? 15,050. 15,050 like this. Alafu so subtract 3. Amount 85,050. Amount 85,050. And then the other one? 23,25. So that will be the closing stock at that date. So that is on 16th. And then after 16th, you check which was the next date. It was on 20th, isn't it? So we have the 20th here. After 16, we have the 20th. They received 1,200 units at 39. So 1,200 times 39, 46,800. 46,800. And then you add 1,200 plus 2325. 131. 131,850. Value 25. 3525. So that is on 20th. And then after 20th, we have note number 3. On 22nd, 208, the officer in charge of stock detected a shortage of 50. So shortage is, so here 22nd, we have a shortage of 50. So shortage, we said we treat it as issue. So it's going to come from the latest receipt. Last in, first out. Last in, first. So this one going to issue using 39. 50 times 39. So 1950. Then we deduct 35. $129,900. And the other one? 3475. So that is on 22nd. And then now after 22nd, we had 24th. 24th, they issued how many units? They issued 900 units. So here we've only issued 50. So the 900 can be satisfied from this batch, isn't it? So now we're going to issue the 900 from that batch at 39. Last in, first out. This is the last in. Huh? 35,100. So this one is going to be 35,100. And then when you subtract, so this is amounting. So 94,800. And then this other one. $20? 25.75. 25.75. That is on 24th. And then on 25th, is it 25th? They received how many units? They received 1,600 units. At what price? At 40. So when you multiply that one, so this one is going to be 64,000. So you add here. $158,800. And this other one? $41. So this one is $41.75. So that is the stock at that date. After 25th, the next one is on 27th. There is returns. So you have 27th here, 175 units that had been issued on 24th. Is it that had been issued on what? On 24th. So that is 39, isn't it? They had been issued by 39. So 175 times 39. Remember, we are using, when it comes to issuing stock, you use the receipt price. The price at which you received is the one that you use to eliminate stock, to issue stocks. You can even see here, the sales price are different from this purchase price. So when it comes to updating your stock card, you update it using the purchase price. That's how. Yeah. So here, how much do you get? 175 times 39. The last one is? I think it's 25th. The last one is 26th. Sorry? Yeah. Just 26, kuna bado 25th. 25th wali received, kuna hiyo ukisoma date number, ukisoma additional information number 2. Oh, kuna 26, Oh, sorry. Before 27, we had 26. You are right. So 26, we had what? So, yeah, she's right. 26 happened before 27, isn't it? So 26, what happened? They issued 1900, isn't it? So now we're going to eliminate this 1900, 1600, last in, first out. So the entire 1600 is going to be issued. This is 64,000. Now it is remaining how many units? 300, isn't it? So we check here. Here we had issued 950. Is it so? 1,200 minus 950? 250. So 250, this one now is exhausted. This one is exhausted. So 250 times 39. It's remaining how many units? 50. So 50 is going to come from this other batch, which is, so now 50 multiplied by 38. So now 675 minus 50, how many are remaining? 620. So here we have 625 remaining. So here we come and multiply. Can we multiply? So 250 times 39. 9750, and the other one? $1,900. So this one is 1,900. And this other one? Eh? 75. 6? 75, 650. I will subtract 75, 650. Subtract napata ngapi? Ngapi? 22. Value itakuwa ngapi? Amount 83,150. $22.75. So that is on 26th. And then On 27th, the next transaction. 27th, what happened? There is a returns of 75 units that had been issued on 24th. The issue price then was 39. Tunaelewana? Ngapi? 68? 68.25. So you take this one, you add to this one. When you add, what do you get? This is 27th. So 27, 25 plus 75, what do you get? Plus 175, not 75. This one is wrong. It's supposed to be 175. Nakuja ngapi? 68.25. So this is 68.25. So when you take 175 plus 22.75, 34? 24.50. So here we have 24.50 and the value 89? 89,975. And lastly, on 28th, they received 500 units. 500 units at 38. 500 times 38. 19. So 19,000. So 24.50 plus 500. Huh? 108. So 108,975. And the unit column, the quantity column. So 29.50. So at the end of the month, we have 29.50 units valued at 108,975. So that is how we maintain it. You can even test it. You still, if you test it, you still get it. Now, this other question also required us to come up with the income statement. So we can come up with the income statement. We have the sales, we can determine the purchases figure. So we have purchases, the units that were purchased. So we can come here with purchases. So purchase is going to be, they purchased 1,000 times 38 plus 1,200 times 39 plus 1,600 times 40 plus 500 times 38. That was the total purchases. So you can add that one. And then they also had sales. They sold items. We have the sales figures. So they sold 350 at 46 plus 500 times 45 plus 400 times 46 plus 900 times 43 plus 1,900 times 44. So what do you get? Then they had return inwards. Return inwards. So there's on 14, 7,500 that had been sold on third. So we have 75 units were returned. So now when it comes to returns, you multiply them with the sales. They had been sold on 3rd March. So the sales 3rd March, the selling price was 46. So here you multiply by 46. Remember, returns inwards, they reduce the value of sales. So you multiply by the sales value, the sales price per unit, plus 175 units that was returned on 27th. which had been sold on 24th March. The selling price then was 43. So that one will give you the sales return. So anyone who has got any value there, either purchases or sales, purchases, 169, 167, 800. And then another one. Is it 179, 300? 179, 300. 10. So 10, 975, 10, 975. Then here we come here and prepare the income statement. The income statement. So we have the sales figure. So you write there the sales, which is 179, 300. Then you less return inwards. Return inwards is 10. So you get the net sales. Net sales, what is the value for net sales? Sorry? 168? 325? 325. That one will be there. Then here you come here and compute the cost of sales. Compute the cost of sales. So we have the opening stock. Opening stock or opening inventory. So you had been given. Now the stock card is to assist you with the inventory management. We're able to tell the value of the opening inventory, which was 90,000. And then you add the purchases figure. You add the purchases figure, which is 170, 167, 800. Then you less closing stock. Our closing stock value will be 108, 975. 108, 108, 975. So that one, if you do that computation, you get what we call the closing stock, the cost of sales. You do that computation, you get the cost of sales. $148, 825. And then here you get what we call gross profit. Gross profit. How much happened? 19,500. And then you less operating expenses. Operating expenses, you've been told, what is the figure for operating expenses? Which is 4,500. Then we had also shortage. We had the shortage. So shortage is also shortage. Shortage of how much? Shortage, we had the cost, 1950. It's also a cost. So we deduct those two items, and then we get the net profit here. So that is how we do the income statement. So the stock card is only to assist us get the values of opening and the closing stock. And of course, when you're given the purchases and the respective sales, you're able to come up with the income statement like that. Any questions so far? Shortage was here, which was it on 22nd? So we have shortage, Sendio. Shortage was done on when? You got 20? Not 22nd, on 22nd. There were 50 units, isn't it? And the cost was 39. So this is the cost is a loss. When you can't be able to identify stock items, then the cost of that stock items, it is a loss to you, to the business. So that is how we do using FIFO method. So you can take a photo of that before we do the last one, the weighted average. The weighted average. So you can take a photo of that very fast. The LIFO method. Of course, you need to also to go through advantages and disadvantages of LIFO method. They can be asked. And then lastly, we want to see another method we call weighted average. So weighted average, it considers when you're determining the issue price, you consider the quantity in store vis-a-vis the value in store. So you divide that one by the issuing price. So we want to use the question that we did in November 2015 to demonstrate how you can use the weighted average. So we are using weighted average and you're using November 2015 as our sample question. So we go to November 2015, you're using the weighted average. We're using November 2015 as our sample question. So we go back to November 2015 question, CPA November 2015 question number 3 as our sample question. November 2015, question number 3B. CPA November 2015, number 3B. So we had read that question before, and the requirement then was use FIFO method, but we want to use the same details to be using our weighted average. So here was the date was which date? The date was so there were issues of July. So this is July 2015. So 1st July 2015, according to the opening balance was 2,000 units, valued at 50. So the opening value was 100,000. That one we had done it, isn't it? Now we record it. We are using weighted average. Here we are using weighted average. We are using weighted. We are using weighted average. We're using weighted average. So now the third here was the next transaction which happened on third. They received 600 units valued at 60. So this one will be 36,000. So you add this one is 2,600. This is 136,000. And then after third, the next transaction after third was on 5th. On the 5th, they issued 500 units. They issued 500 units. So how do you determine the issue price when you're using the weighted average? We said you take the value in store, you divide by the quantity in store. So you take 136,000 divided by 2,600. At the date of this issue, the value in store was 136 and the quantity in store was 2,600. So what do you get? Huh? 52.3. So we can just write 52. So we can round it off 52. So you multiply 500 by 52. So this is 26,000, isn't it? So you take 2,600, you deduct 500. You take 2,600, so here you get 2,100, and you take 136,000 minus 26,000. What do you get? 110,000. So this one is 110,000. So that is the transaction that occurred on 5th. Then after 5th, we had another one on July 7th. That was the next one. July 7th, they received 1,000 units at 70. So this one will be 70,000. So you take this 70, this 1,000 here, this is 3,100, and then 70 you add 110. You get, is it 180? Is it 180? On the 5th, how many units were issued? I think this one is a mistake, isn't it? So they issued how many units? So this one is 1,600 units that were issued, isn't it? At 52, what do you get? I think we're doing a mistake here. The one, 80? 82? 83, 200, yeah. And then now you deduct. What do you get? Is this 1,000 here, isn't it? And then now here? I think this one is 52,800. So we're doing a mistake. And then now here we come here. This one should be 2,000, isn't it? And this other one? Sorry? 1, 2, 2. I think that is the correct position, isn't it? Now, after the 7th, what happened? The next date is on 9th. So 9th, on 9th, part of material issued on 5th July amounting to 200 were returned. So there were return of 200 that had been issued on 5th July. So we return them using 52. We return them using 52. 200 times 52? Huh? So this one will be 10,400. Then you add this one is 2,200. 10,400 plus this 122. 122,800. 133. So this is 133,200. That is on 9th. And then next one is after 9th. On 12th, isn't it? So on 12th, they issued how many? 400 or 200? So 400. The issue price, you take the quantity in store against the price in against the value in store against the price. You divide. Unapata ngapi? 60.4. So it will be 61. You rotate it, you round it off. 24. So this one will be 24,400, and then you subtract. Amount 180. 108. 800. And this other one? 18? 18,800. 1,800. I hope you are seeing. And then the next one is after that is on 12th. What is the next transaction? 15th. So 15th, what happened on 15th? So 15th, 100 units were returned. So you have not specified the date of issue. So you just assume the latest issue. So they're coming from that batch. So 100, this is going to be 6,100. Then we take this one, is going to be 1,900. This other one. Eh? 114. So this is 114,900. That one will be the value. The next transaction after 15th, 18th. So 18th, what happened? 2,400. 2,400 at 80. So what do you get? 192,000. So 192,000, you add 1,900 plus 2,400. Eh? 4,300. Na hiyo 106, 306, 900. And then the next one, On 20th. That is the next transaction. What happened on 20th? Issue of how many units? 1,200. So you divide this one to get the issue price. 17. 71. So this one is 71. When multiply, so this one will be 85, 200, and then this one. Amount 1,700. 2,1,700. Then the quantity 4,300 minus 1,200, 3,100. So this one is 3,100. Tunaelewana? Then the next transaction after 20th, 21st, there was some wastage of how much? So wastage, you said, is you treat it as issue. There was an wastage of, is it 500 units? 500 units. So you divide this one, 22,1,700 divided by this one. What do you get? Say? 72. So 72 here, you multiply 500 times 72. 3,600. 36,000. And then you subtract. Yeah? 185. 185. And this other one? 2,600. Then after 21st, the next date, the next transaction was 21st on 20. Is it 25th? 25th, 100 units of what received. Returns. So I can say 25th. Is it 25th? 25th. So 25th, we had how many returns? 100 units. So at 45, isn't it? So this is 4,500. This one will give you how much? 2,700. Then when you add 185,700 plus 4,500. $190, 190, 400, 200. Sindio? Tumeelewana? 190, 200. And then lastly, we had 28th nini ilifanyika? 28th, a shortage of how many units? 20 units. So you divide 190, 200, divide by 2,700. You divide that one. We're determining the issue price. We're determining the issue price 70. So this one will be the 70. 20 times 70. So this one will be 1,400. So 2,700 minus 20. 2,700 minus 20. 26. 26, 80. And this other one? $188. 188, 800. Next. 29s. They issued how many units? 600. You divide, what do you get? 70. So 600 times 70. 4,200 or 42,000? 42,000. 42,000. 2680 minus 600. 2080. And then you subtract that one. 46. 146,800. And then lastly was 31st. So 31st, they issued how many units? 200. When you divide, what do you get? $71. So when you multiply, 14,200. And then what do you get? 1880 and 136, 132, 800, 600. So that is how we do weighted average. I think it was examined that the other way. The other one season. You have all the past papers with you? I know the latest one. Can I? Yeah, let me see. So I think we had a question of this kind just the other day. So we had the August 2022 question number 1. Can you check August 2022 question number 1? I think that question came August 2022. August 2022 question 1. Can you see that question? So they wanted the student to use the weighted average. How many marks attached to that question? 10 marks, isn't it? So in other words, these questions are examined. So you also look at the simple average at your own free time. I have given you the last page of that handout. So you see whether you can be able to understand simple average, isn't it? So if you don't, you have issues, you let me know. So I have given you assignment 2 questions on inventory management. Also, you can also do this one. Let me see. So we are going to be identifying questions on inventory, and we are going to be doing them. So you can also do April 20 assignments. Make sure you submit your assignments. April 2022. April 2022. We had question number 2. So there were so many questions. So that question had so many marks. April 2022. April 2022 question number 2B. Attempt that one, and question number 3B and 3B. So you can attempt April 2022 question 2B and 3B, please. So those ones are questions on inventory. And then you study, you see whether you can understand the simple average on the last page of that handout. And in case you'll have issues, you let me know. So that one will be the end of our class today. So make sure you attempt assignments, and if you're online, you submit. So niandikia pa date ya leo. So that is the end of our class today, until maybe next time. So next time we'll be starting on a new topic. That is labor remuneration. Labor remuneration. That is on Friday. So for inventory, we just be doing questions. We identify so many questions and do them. And you keep on repeating what you've already studied.